Welcome to Chapter 7, where we'll talk specifically about income for property. Generally, income from property is where little or no effort is required. There are some different rules to be considered, hence why we have Chapter 7 in front of us. Some of the common inclusions are interest, rent, dividends, or royalties, and does not include capital gains, as we talked about that in a prior chapter. We will also talk about some of the concepts around interest, where sometimes it's deductible, sometimes it's not, and in Canada we talk about does the borrowed money produce income, so we'll talk a little bit about that as well. Interest typically has to accrue on a continuous basis, so it's not just random points in time. It must be calculated on some base or principal sum, and it has to be compensation to your organization for the use of that principal sum. In some cases where you've paid interest in some situations that aren't deductible, these typically include loans for RSP or personal TFSA contributions, loans for any personal property, so that's property that doesn't belong to the business or is consumed by the business, and late income tax payments or penalties incurred. A couple of examples are included in the text on pages 303 and 304, where it talks about the direct use must be considered. So the first example against the Queen versus Singleton, it's where a partner in the organization borrowed money from his capital account and bought a personal residence, and then went and got a mortgage to pay the organization back, and then wanted to deduct the interest on his personal mortgage. And it was deemed, and rightfully so, that the purpose of the loan was to buy his personal residence, which is not eligible for deduction. On pages 304 and 305, we talk some examples of direct use and where you restructured borrowings, replacement of single income or multiple income producing properties with others. So these are all examples of where the intent of the borrowed money and the interest on that borrowed money was to generate income for the business. And even if you shift that, resold those assets and repurposed the proceeds to another purpose, it was still to generate business income. So it continued to be a direct use in these cases. There are a couple exceptions to the direct use approach, and where an organization borrows money to what they call fill the hole, where they need to pay off dividends, redeem shares, or return capital to another corporation. That can be considered acceptable. Or where they provide interest-free loans, and examples are where they provide it to a subsidiary organization or to employees, all on the intent that it's to help generate business income. When it comes to borrowing money and incurring interest expense to buy common shares, it depends on the intent. In most cases, organizations would buy common shares with the hope that they pay dividends or grow in value over time. So then in those cases it would be deductible. In some situations, and there's an example on page 306, where an organization issued common shareholders and was very explicit that there will not be dividends. There is a fixed price at a certain point in time to resell in the future, and in this situation it is not reasonable to expect income from any such holdings, and therefore interest expense would not be deductible. So it really depends on the intent of the common share purchase. And many times an organization will issue debt where the interest rate is either above or below the current market interest rate, and that'll create either a discount or premium. You may recall this from previous courses, and we'll walk through some of those examples. Now, when there's a discount, the deductible interest rate will only be based on the coupon or the stated rate on the bond, and any excess amounts paid when the bonds are retired or for proceeds is fully deductible at maturity. Only if it's not less than 90% of the maturity value and the effective yield is not more than 4/3 of the stated rate, which we talked a little bit about in Chapter 6. Alright, if you're the issuer of a bond and you create a premium, it depends on what business you're in. So for example, if you're deliberately created a premium and you would amortize that premium over the period of the bond period, and therefore would reduce the interest expense. If there's no deliberate premium, the premium would have no immediate tax consequence, and the interest deduction would be at the coupon or stated interest rate, and there'd be a tax-free capital receipt for the premium amount. If otherwise, the interest deduction would be simply the coupon rate or the interest rate on the face value, and there'd be an income inclusion right up front for the capital component being the $400,000, for example, in exercise 7.2, which I'll walk through later. Okay, an example with the discount and premium, we'll walk through some. Where we have bonds of maturity value of $1 million issued at 980, interest at 10% maturity, and is paid annually, and bonds mature in 20 years. So in this case, we have an interest expense to the issuer of $101,000. We have bonds payable, discount being $1,000, so that nets to the $100,000 payment being sent, which is the cash credit for $100,000. To the investor, they would receive $100,000 into their bank. The bond investment would slowly increase by $1,000 that year, and the revenue of the investor would be the $101,000. It would be tax expense and revenue. And at maturity, for the investor, the extra $20,000 received is a capital gain, 1/2 of which is taxable. The issuer will get the extra $20,000 paid is a deduction if the issue price is not less than 97% of the face value, which it is not, and the effective yield does not exceed 4/3 of the stated yield. Otherwise, it's an allowable capital loss. Now, Income Tax Act Section 12.3 requires full accrual for interest, and it's generally the same as GAAP. For individuals, the Income Tax Section 12.1c allows use of cash basis receivable or the full accrual, so you have options as an individual. But the accrual rules under Income Tax Act 12.4 is that the interest must be accrued on each anniversary date of the debt, so not on an ongoing basis otherwise. We'll walk through an example where we have a 5-year $100,000 bond issued on January 1st, 2020. It pays an annual interest rate of 10% only at maturity. No cash flow until maturity. Therefore, you'd have to record the interest on each January 1st regardless of when the bond was purchased. Another example is when there's accrued interest at purchase. Here's an example, October 1st, 2020, we bought a $100,000 bond with an annual interest payable at 10% on December 31st, 2020. The price of the bond was $107,500. The $7,500 will be included in the income of the transferor, the person who sold it to us, and the $75 will be deducted by the transferee as per Income Tax Act Section 2014. A couple other payments based on production or use. Talk about rents and royalties. Rent is to be earned based on the accrual method, and you're to include rents in the income for the year in which they were due, whether or not you received them in that year. You will also deduct any expenses in the year that you incur them, no matter when you pay them. For royalties, they can be earned income for RSP purposes only if you're a writer, composer, inventor, etc. So it is spelled out. Here's some examples of the various deductions associated with rents, and as mentioned, it's on an accrual basis. As we talked about earlier in Chapter 5, you need a separate class for each rental property where the costs are greater than $50,000 for each property. And CCA cannot be used to increase or create a rental loss. If you already have a rental loss, you would not claim any CCA, and you can only claim CCA up to the maximum allowed or up to the available income before CCA. Little example about rental income is where an individual acquired a property for $120,000. We're ignoring the land component. It's rented for $1,200 a month and has a $90,000 mortgage at 9%. Condo fees and taxes are indicated. So in this situation, you have rents for $14,400 for the year, 1,200 times 12, taxes at $3,000, interest at 9% of $90,000, we're just assuming flat at $8,100, condo fees at $1,800 for total expenses of $12,009, which gives you a rental income before CCA of $1,500. After that point, you can then claim your CCA. Doing the calculation on the property, it would be 4% of the $120,000, half-year rule. So therefore, the maximum CCA you could claim is $2,400. However, you only have income of $1,500, so you would only claim $1,500 in CCA for that year, bringing your rental income down to zero. All right, some of the next little conversation will focus on the concept of what we call integration, where the idea is whether there's a corporation in place or not owned by an individual, the after-tax income should be about the same amount no matter what. So from a tax perspective, there are gross up and credit procedures, and it varies between whether it's eligible or non-eligible. For the non-eligible side, you gross up is 15% of the dividends received, and you get credits. Federal credit being 9/13 of the gross up, and provincial credits being between 6 to 6 to 36% of the gross up. For the eligible dividend side, there's a gross up of 38% instead of 15. The federal credit goes to 6/11ths of the gross up, and the provincial credits go anywhere between 19.6 to 50.8% of the gross up. Little example about the gross up tax credit procedures for non-eligible dividends. So there's an example where there's corporation earnings of $10,000 and the corp pays 13.04%, which means there's $8,696 available for dividends. Assuming they pay 100% of that out, it's grossed up by 15% to give you the taxable dividends. The tax at 45%, which is the marginal tax bracket of the person being paid, $4,500. The dividend tax credit, as per the calculation algorithm, is a 1304, which total taxes payable then are $3,196. The cash retained by the person receiving the dividends will be the $8,696. Take away the $3,196 to be $5,500. And on the flip side, as if they were received the $10,000 directly at the 45% tax margin that we state that they are in, they would get $5,500 in that case as well. Concept of integration. And eligible dividends defined in more detail in Chapter 13, but it's typically amounts paid to Canadian residents by either public corporations who are resident in Canada that are subject to general rates, or CCPCs out of active business income taxed at general rates, or CCPCs out of eligible dividends received. Another little walkthrough on the eligible side where it's taxed at the corporation level, 27.5%, available for dividends at 72.46, paid amount in dividends with a gross up of 38%, tax at a 45% tax bracket, with a dividend tax credit as determined as per the formula earlier, total taxes payable of $1,746. Deducting that amount from the $7,246 declared and paid as dividends, you'll have $5,500 after tax. And if they directly receive the cash being $10,000 times the 1 minus the effective tax rate of 45%, would also receive $5,500. So just a little example for the maximum tax brackets or tax rates for 2020. There's a schedule on page 323 in your textbook for additional details for other provinces, but in Ontario you pay an effective tax rate of interest for 53.5%. Capital gains would be 26.8, non-eligible dividends 47.7, and eligible dividends at 39.3%. Some general comments about taxations of trusts is that if the trust income is distributed, it's taxed in the hands of the recipient, so whoever received the relevant allocation, and there's no tax at the trust level. For publicly traded income trusts, it's important consideration on page 326 talking about the adjusted cost base. And in that situation, it always starts with the cost, but then you add any amounts that are reinvested from potential distributions, and then you deduct any return of capital taken by the owners. Something to be considered is that publicly traded income trusts were very popular, but it actually created some negatives when it came to tax, especially for non-resident investors or tax-exempt entities. So tax procedures were changed in order to recapture some of those taxable situations. And now the government only allows real estate investment trusts. When it comes to mutual fund dividends, firstly, most mutual funds are organized as trusts because they're held in behalf of the investors. However, mutual fund distributions retain the original character of the income being earned. So whether it's a capital gain, interest, or dividend that was earned by the mutual fund, any income distribution paid out to the mutual fund holders would keep those characteristics. When mutual funds distribute earnings, they are subject to tax even if they're reinvested, and any reinvestment is added to the adjusted cost base for that mutual fund. Stock dividends are treated exactly like cash dividends for tax purposes. They are added to the adjusted cost base of shares for the investors, and because of the tax complications, they're actually not very often used by public companies because you haven't transferred cash to a stockholder, and yet they'd be taxed on it, so putting them in a situation where they might not be able to pay the tax. For capital dividends, it's important to understand that because the way things are taxed, that the corporation would typically hold that 50% held back in a capital dividend account, and when it's distributed to the stockholders, it would be received tax-free, and it doesn't change the adjusted cost base in those situations. Or where you receive foreign source income, where it's non-business income, you include 100% net income. You get a credit against any payments withheld by that foreign country. But the credit is a maximum of 15% for individuals. Any excess is a deduction. There's no carryover. However, if it's foreign source income recorded as business income, you include 100% net income, and you receive a credit against Canadian tax payable for all foreign taxes withheld, no limit. Little example here where we earned $1,000, we received $850, so they held $150 back. So we record the $1,000 in income. Our tax bracket here in this example is 40%, being $400, but we get a credit for the $150, leaving $250 owing here. Total amount paid would be the $150 foreign plus the $250 in Canada would be $400 in total tax, which is the same as if we had it all received in Canada. Some other considerations are around shareholder benefits. Some examples included are lower interest-free loans, giving them cars, some non-business travel, or improvements on their personal residences. In general, it must be included in income of those people that are receiving those benefits. And also in general, it's not deductible to the corporation, but much more detail in Chapter 15. That's the end for Chapter 7.